Thank you all for joining us. I'm really glad to see you all this evening. We thought that now would be a good time to do a seminar like this, Save Lives, Save Money, because the market has been pretty kind to us this year. So we want to take advantage of our charitable giving and learn about how we could potentially even give more than we might otherwise have thought we're able to, and possibly lower our taxes at the same time. Now that is truly a win-win because it's good for you, but even though we're here to educate you, if you learn something and you take it away, it could potentially enable you to help even more animals. So that's why we're all here. That being said, I would like to introduce our guest speaker tonight, both Kevin Henderson and Tom Henderson, who are with Henderson Wealth Management. They are financial advisors located right here in Fairport, New York, specializing in holistic wealth management, where they help manage all aspects of a client's wealth. They are fiduciaries, but more importantly, at least for us anyway, they are animal lovers and friends, really good friends to Lollypop Farm. Kevin has a lovely little spoiled Shih Tzu that I have met. And Tom has 4 cats, and a new addition is a beta fish. Yeah. Yes. That the cats love to watch. That the cats love to watch. Awesome. When I turn it over to Kevin, I just want to let you know that we are happy to answer any questions that you might have. If you're live in person, just raise your hand and we'll get your question answered. If you are on the Zoom, just type it into the chat, and lovely Robin here will make sure that those questions get answered. I hand it over to you, Kevin.
Beautiful. Thank you, Kathy. Really appreciate the opportunity to come out and speak to you tonight about all the various ways that we can continue to support great organizations like Lollypop Farm. We love animals. We love supporting Lollypop. It gives us great pleasure to, again, be here tonight. You know, it's interesting as you look at Lollypop's vision, a just and compassionate world for all animals, and then their mission statement, together with our community, we better the lives of animals through justice, prevention, and life-saving care. What are the reasons? Why do you support Lollypop Farm? You love animals. You got it?
Yep.
Perfect. Well, I'll come back to that one. So, you love animals. What else?
I like to contribute to support the animals in the shelter, as well as the cruelty prevention, and a little bit for how they distribute it, that I get, just that I hate seeing them not having homes and being loved and being given up, and I know they try to, help people in need as well, so that they can keep their pets in their home, to all the different various programs.
Beautiful. And Lollypop's a wonderful steward of your money. Obviously, they're a great organization. You trust them to really utilize the funds that you do donate, the time that you do donate properly. There's a personal connection for many people. We're all pet lovers, so we want to make sure that we can pass that on. We hear more and more from our clients that they want to demonstrate through action and educate their children and their grandchildren in organizations and things that they believe in, that it's more than just about you. It's about the community and things that you have belief in. But we also do it for tax deductions. So again, if we can benefit or enhance the gifts that we're going to give, let's take full advantage of it. And that's one of the things that we're going to be talking about today, is a number of different methods and ways that you can support Lollypop. We are not going to give specific tax advice, legal advice. We really encourage you to always sit down and talk to your tax preparer, your estate planner, your financial advisor to identify what method or methods are best for you. So even though I have a very strong working knowledge of law and tax, I did not sleep at a Holiday Inn Express last night So again, we're going to keep it very high level, but again, hopefully give you some information that you can take away today. So what are the various ways that we can give? Obviously, outright gifts, bequest, gifts of life insurance, appreciated securities, gifts from your IRAs, donor advised funds, gift annuities, charity remainder, and lead trust. So we're going to be touching on all of these. But before we do, we want to touch on proactive planning. And the proactive part is very important. If you wait until February or March when you get all your 1099s and W-2s and then you sit down with your tax preparer, there's very little he or she can do to help you save taxes in 2021. So if you are planning on giving or giving more or changing in the methods that you give, we really encourage you. Third, fourth quarter of the year is an excellent time to sit down with your CPA, your tax preparer, your state attorney, your financial advisor, and really revisit everything because the tax laws are always changing. So we want to be very proactive in the planning that we do. So I'm going to touch a few minutes on tax brackets. Now we know there's a new president, there's a new Congress. These tax rates and brackets may change retroactively or into 2022, but we know what they are now, and we just want to really touch on this for educational purposes. The column along the left, those are what we call your marginal tax rates. Then you either file single, head of household, or married, and then these are the current standard deductions. Okay. There's a difference between your marginal tax rate and your effective tax rate. So if you happen to be a single filer with income of just over $52,000, you take your standard deduction, that brings your income down to $40,526, let's say. That does not mean that you're paying 22% on $40,000 of income. On the first $9,950, you pay at 10%. Then up to $40,000, you pay 12%. So really, it's only that $1 that you pay at 22%. So that's what we call your marginal bracket. But if you did the math, you'd see that your effective tax rate was about 11.5%. The reason I point this out is that if you earn one more dollar above that $40,525, you're going to be taxed at 22%. If you give a dollar at that level, you're going to save 22 cents on the dollar. Okay? So we want to know where your tax bracket falls. Oh, and this type of income is taxed for earned income, interest income, IRA distributions, monies out of your 401ks. That's taxed as ordinary income tax rates. Then we have your long-term capital gain rates. So this is if you own an asset. You hold it for over a year, and then you sell it for a profit. It is taxed at a long-term capital gain rate. And what do you notice about these rates versus the ordinary income tax rates? They're lower. So again, we'd much rather receive our income in the form of capital gains than ordinary income because it receives much more favorable tax treatment. So it's very important as you start to look at your overall financial and estate plan to identify what tax brackets do you fall in. Because as we start looking at the various ways of giving and whether or not you're doing a standard deduction or you're itemizing your return, that will really kind of steer us to which method or methods of giving make the most sense for you. Does that make sense? So there is an above-the-line charitable deduction that everybody can get, whether you itemize your return or take the standard deduction. So if you're giving $600 a year, you can just deduct that right off your tax return. $300 for single individuals, up to $600 for married filing jointly. So what's interesting is back in 2017, 36.8 million Americans itemized their tax return and took charitable deductions. In 2018, that dropped to 14 million. But what's really interesting is those folks that are charitably inclined, the amount of giving did not drop. But what we did see is bunching of contributions. So if someone normally gives $10,000 to Lollypop on January 2nd every year, in December of 2017, because they did proactive planning, they talked to their accountant and they said, wait a minute, if I wait until January of 18 to give my $10,000 to Lollypop, I'm no longer going to be able to deduct it because those standard deductions are so high. So let's push that forward. Let's bunch the two together. So that individual couple may have gave $20,000 in 2017 and nothing in 18. And then come in 2019, maybe they give 20 grand, so they give, again, 20 in one year, nothing the next year. They're bunching them so they can itemize that return. Okay. But right now, only about 10% of Americans itemize their returns. So that has changed dramatically. There are limits as well. So whether you do donor-advised funds or you give appreciated assets, depending on your adjusted gross income, it can be capped. So once again, you want to talk to your tax person. I'm going to make a sizable gift. He or she will identify, well, here's where your adjusted gross income, this is how much deduction you can take this year, and this is what you can carry forward within the next 5 years and use it up. So again, planning is really key. And since we're over the tax part, the difference between cats and dogs, right? So let's talk about outright gifts. Okay? They're awesome. It's simple, it's easy, you write a check, it's automatically deducted from your checking or savings account. There's no minimum, there's no maximum. The problem with a gift is when you pass away, that gift ends. And depending on how much you give, it may or may not be deductible. So again, if you're giving more than the $300 or the $600, but not giving tens or hundreds of thousands, you may lose that deductibility. But again, you're still supporting the organization. Bequest. This is a wonderful way through your estate plan, typically through your last will and testament, or within trust within your will, that you decide you want to leave cash or certain assets to Lollypop Farm. It's a wonderful way to leave a legacy because you've been able to utilize those assets for your lifetime to support your lifestyle, and now that you're passing on, you want to leave a legacy to Lollypop. But as we look at the various assets that you can give, I think it's important to understand how assets are inherited as well. Many of us have children or grandchildren that we want to leave some or all of our assets to. So how do we leave assets to our children and grandchildren, but also support the organizations that we believe in? When you pass away and you leave monies to children or grandchildren, appreciated assets receive under current tax law a step up in cost basis. So if you bought a stock for $10,000 and it appreciates to $100,000, you pass away, when your children or grandchildren inherit that stock, they inherit it at $100,000. In other words, they get it tax-free. Same thing with your personal residence. Same thing with life insurance. Life insurance is tax-free, right? There's a beneficiary designation. Any life insurance that you leave your children will go to them completely income tax-free. So all those get step up in basis. But what's an asset that most of us have that will not be inherited tax-free or will not receive a step up in tax basis at your death?
IRA.
IRAs, 401ks. So if you leave a child your IRA, depending upon your age, their age, it's a very good chance that they may be in their peak earning years. Their marginal tax rate's at that 22, 25, 30+%. Plus, depending on what state they live in, assume they live here in New York, another 6 or 7% on top of that. So you leave them a $100,000 IRA, they're going to have to liquidate that within 10 years of your death. And if they're in the 30% bracket, they're going to end up with 70 grand. So that's the one asset of any of them the kids don't want. So consideration may be given, hey, I want to support Lollypop. Boy, I'd like to leave them $100,000. Why don't I name them as my beneficiary on one of my life insurance accounts, or partial beneficiary? They inherit the $100,000. The kids get all the other assets with a complete step up in basis. It works very well. So again, as you're making various bequests, look at the different assets that you have, how they're going to be inherited, how they're going to be taxed, and then again, you're able to make the decision that maximizes the gift to Lollypop, but at the same time minimizes any income tax to the kids. Yes?
I have no children. I might have some cousins and nephews and such, but I have my fur babies. So if I wanted to make a charitable donation to an organization that's a hopefully no kill, you know, my animals would, if they're still alive when I pass away, would be go to those shelters if nobody else take care of them, and then have that bequest or whatever go there to take care of them in the shelter until hopefully they're adopted.
Yep.
That would be my thought with finding the right place, you know.
Yep.
I can
Yeah.
step in for
Yeah,
a minute.
please,
Do you want
Kathy.
to turn my mic on? So just to answer that real quickly, not to
No, please.
take
That's
over your
perfect.
presentation.
No, perfect.
That is our pet guardian program. So that is a benefit for individuals who have left Lollypop Farm in their will. We're talking about bequests. So as our way of saying thank you for leaving Lollypop Farm in your estate plans, we make a guarantee to you that we will provide for your pet, and we will do our very best to find them the perfect new loving home. And it's our way of saying thank you.
And again, I think that's what's so great about Lollypop is they have people, you know, here to sit down and talk with you and identify what are your true needs, and then try to identify the best way to accomplish it. Yeah. Beautiful. Good. Yes, sir.
Is there a difference in treatment between a Roth 401k and a traditional 401k or IRA?
Well, obviously,
Kevin, can you repeat the question
yes,
for the Zoom
I'm
people?
sorry. Thank you. Yeah, the question was, is there a difference between a Roth IRA or 401k and a traditional IRA or 401k from a tax standpoint? Yes, your Roth IRAs, your Roth 401ks will be inherited by the beneficiary tax-free.
Right.
Yep.
Yeah.
So,
Okay.
yeah, they still will have to liquidate that within 10 years of your passing, but there's no tax impact at all. That's correct. Yep. Very good. Gifts of life insurance. It's not uncommon that we see when we're young, we get married, we start our family, we have no assets. We're barely paying our bills. So we buy life insurance, and typically a lot of it. We want to make sure that in the event of our premature death, our income is replaced, our mortgage is paid off, our children are educated. But as the years go on, the kids grow, your portfolio grows, the kids fly the nest, you pay off the mortgage, you've accumulated now an asset portfolio. Do you really need the life insurance anymore? You may not. So a lot of people will outright cancel it, which is fine if you don't need it. But you may say, you know what? I want to leave this asset to Lollypop. I no longer need it, but I know Lollypop needs it. And it's a wonderful way to magnify your gift, because none of us get out of here alive, right? It's inevitable. So there are a number of different things that we can do. Again, the only two things guaranteed in life are death and taxes. So you can give Lollypop Farm an existing life insurance policy that you own. And if it's a cash value life insurance policy, whatever that cash value is what you'll get a tax deduction on, potentially, again, depending on the amount, et cetera.
Question.
Yes, sir.
How about if I make Lollypop the beneficiary on the policy?
Yep. So what if you can make Lollypop Farm the beneficiary?
When do I get that tax benefit?
So if
My
you-
estate does.
So if you retain ownership, yeah, you're not going to get one.
Okay.
Yep. Okay. So typically, again, depending upon your net worth, your assets. Do you have an estate tax problem? That's typically where, if we have an estate tax problem, we want to get that asset out of your taxable estate. So again, that's where your tax advisor and planner may say, what I'd really suggest you do is you actually gift the life insurance policy to Lollypop Farm, and that gets it out of your estate. And if it has a cash value, you'll get a potential tax deduction.
I have a paid-up policy from when I worked for a company that started with an X.
Yep.
And I've made Lollypop the beneficiary.
Perfect.
Is there some way that I could gift that to them now?
Yes. You would contact the insurance company, work with Kathy and her team, and they would help you identify the process of actually gifting that life insurance to them. And that
Now,
could potentially give you a tax
The cash value
deduction.
of that policy, the surrender value is about half of what the death benefit is. What would they get, the surrender value or the cash value?
They get the death benefit when you pass.
Okay, so they're, okay.
Yep, yep. So you're not going to surrender the policy. You're going to maintain the policy. You'll
Well,
get the
it
deduction.
doesn't cost me anything, it's already
Anything,
paid
right.
up.
Yep, perfect.
Okay.
Yep, so that works very well. But you can also retain ownership. You know, I still need some of that life insurance. So I'm going to retain the ownership where you won't get the tax deduction, but I'm going to name, you know, I got $250,000, I have a child and a spouse. I'm going to leave $100,000 to my child, adult child, $100,000 to my spouse, the remaining $50,000 to Lollypop. So always when you're looking at changing beneficiaries, it's not an all or nothing proposition. You don't have to leave all of it, but whatever portion you feel comfortable with or fits within your giving needs, plans, as well as your estate plan, that's what you look at. But you have options. You also have the option of purchasing, oh, I'm sorry.
Excuse me, sorry, you're turning the other way. So if I only have like my employment basic life insurance, service life insurance, and I basically, that's enough like to pay for funeral, whatever else, this and that. So would you stipulate like in a will, pay off any debts, funeral needs, and the rest would go to Lollypop, is such thing?
Yeah, so,
How's that?
so again, if you have employer provided life insurance, you can name Lollypop the beneficiary, but if you want to make sure all your debts are paid first, then you would probably have it payable to your estate. It would come in, any debts, and then within your will, you would say, hey, any remaining assets in my estate, once all my expenses are paid, please give that to Lollypop Farm. Yep, so I think that's how you would do that. You also have the ability to purchase a new life insurance policy. So this is where you would work with Kathy and her team. Now, obviously, if you buy a brand new policy, what happens? You have premiums, right? So Lollypop isn't going to say, hey, we're going to pay a $100,000 a year premium on your $1 million policy because someday you're going to die. But let's say you could buy a $500,000 policy and it costs you $10 grand a year. And you're giving Lollypop $10,000 a year. See where we're going? So Lollypop owns a $500,000 life insurance policy on your life. You give them $10,000. They in turn pay the premium on that policy. When you pass away, that $500,000 comes tax-free into Lollypop Farm. And now that can go in the endowment and continue to, in essence, give Lollypop and generate income $10,000 plus a year forever. You may even get a building or a room named after you. All right? So again, we can also look at assets that you typically don't even think about as investment assets. Again, life insurance serves a purpose, but once that purpose is fulfilled, you've got some options. Cancel it, change the beneficiary, make sure you can build a legacy. Again, cost efficient, tax beneficial, magnify your gift, secure and confidential, and again, very helpful to Lollypop's mission. Gifts of appreciated securities. You give an appreciated asset directly to Lollypop. So we used my example earlier. You bought a $10,000 of an individual security and it's appreciated to $100,000. if you want to give that $100,000 to Lollypop, you go and sell it outright, you're going to own capital gains tax at that 15 or 20% rate, plus a 3.8% surcharge, the Medicare surcharge, on top of that. So you're going to lose, you have a pretty big tax bill. So instead of you selling that security in order to give it to Lollypop, you gift the security itself to Lollypop. So you give them that $100,000 stock. They in turn sell it. You get the $100,000 tax deduction, you have no capital gains, and they benefit beautifully. Okay? So it's a great way, again, of working out of highly appreciated positions and minimize your tax.
They get the full 100,000?
Bingo.
Tax-free.
Tax-free, because they're a non-for-profit. Okay? So it works very, very well. No headaches. It truly is very, very easy. Kathy can walk you right through the form, and every financial advisor knows how that works. It really is a wonderful way to give. We do more and more of these every single year. Qualified charitable distributions. So a couple of you in the room may be over 70 and a half, or maybe over 72. So most of us are familiar that at age 70 and a half, there's something called the required minimum distribution. Now they bumped that up to age 72 last year. So now you are required to start taking money out of your retirement accounts once you turn age 72. And that rate is around 4%. If you do not take out what you're supposed to, the amount that you didn't take out that you were supposed to, there's only a 50% excise tax. So you'll want to make sure you do that calculation properly. Another point, if you have money still in a 401k plan and you have money in your IRA and your required minimum distribution is $20,000, you take all $20,000 out of your IRA, you're in violation. The 401k and the IRA are two different plans. You've got to take 10 out of the 401k, 10 out of the IRA. If everything's in an IRA and you have 3 IRA accounts, they don't care which account you take it out of. You can take it out pro rata, you can take it all out of one because it's the same registration. Okay, very important point. Yes?
Some people that have 401ks when they're retired turn that money over into IRAs so they can be distributed, on a monthly basis for income.
Yeah, so
Supplemental to their other basic retirement income from their.
it depends on your plan. So the question was, when you retire, you have money in a 401k plan. Can you leave it there? Do people typically turn it over to an IRA? It's really a personal choice, and it's somewhat dependent upon your plan. So I know some employer plans, there was a real big one, I think they used to still make cameras, that they would, if you wanted to take money monthly out of your 401k, you could, but once you started that monthly distribution, you couldn't stop it. So every plan is different, so you want to talk to your employer to identify what your options are with your 401k. But normally when clients reach the age of 72, we encourage them to get everything consolidated in IRAs, just so this required minimum distribution is calculated properly. So you're going to have options. So we have many clients that say, oh my gosh, I have to start taking this money out of my IRA. I don't need all of it. That's a good problem to have, all right? Very good problem to have. But the government requires you to do so. So obviously, if you're having to take your required minimum distribution out, it may push you into a higher marginal tax bracket. It may reduce your eligibility for tax credits or deductions if you're itemizing. So to eliminate or reduce that, if you are charitably inclined, you may want to give to charity through your IRA. So what is it? It's a direct transfer of funds from your IRA from the custodian directly right to your qualified charity. You can do this as long as you're over age 70 and a half. Now, it's not the calendar year you turn 70 and a half, like RMD, okay? So if you turn 70 and a half on December 1st, and you do a QCD today to Lollypop, you're not 70 and a half. So if the IRS ever caught you, they may disqualify that. So again, you want to wait till you're 70 and a half. You can do, it can be used to satisfy your required minimum distribution up to $100,000 a year, and any money that you give from your IRA directly to Lollypop Farm is excluded from your income. So we encourage people that are doing QCDs, keep a list. We keep a list for our clients, and we send our clients a letter at the end of the year. You made contributions to this, and this amount. Please provide this to your tax preparer. Because we want to make sure your tax preparer is aware of that you did QCDs, so he or she reports it properly. If you take required minimum distributions as income instead of as a QCD, your distribution will count as taxable income. Having lower taxable income could help you be eligible for certain deductions and tax credits, which we've already talked about. So let's walk through a couple examples. We have Jane. Her required minimum distribution for her IRA this year is $20,000. She decides that she wants to give $15,000 of it to Lollypop Farm. She takes the remaining $5,000 in cash. She's taken out her $20,000 to meet her required minimum distribution, but she's only going to be taxed on $5,000 because the $15,000 went directly to Lollypop, tax-free.
Kevin?
Yes, sir.
Are you using the term IRA and 401k synonymously?
No. So employer-sponsored programs are not eligible to do QCDs, qualified charitable distributions. So 401ks, 403bs, you're not eligible. IRAs, inherited IRAs, simple IRAs, SEP IRAs, they are eligible. Yep. Employer-sponsored plans are not. Here Jane decides to give all $20,000 of her required minimum distribution to Lollypop. So she took 20 grand out of her IRA, 0 income tax. Example 3. Her required minimum distribution is 20 grand, but she decides to give 25,000 to Lollypop. That's fine. All 25,000 is deductible. Or tax-free, I should say. What you can't do is she can't say, well, you know what? I'm going to give an extra 5,000 this year because I don't need it, and if next year, if my required minimum distribution is still 20, since I already gave 5 last year, this year I only have to take out 15. No. Okay, you can't carry that forward. So your required minimum distribution is calculated based on the account value on December 31st of the previous year. Okay, and then there's a factor, it's a life expectancy table. So at age 70 and a half, it used to be, I think, you take your account value and divide it by 26.5, which works out to be about 3.8% rate, and that determines what your required minimum distribution is. So it's a calculation that is done and recalculated each and every year. And it's important that it's done properly because you want to avoid that 50% excise tax. So, but it works very well, especially if you don't need the money and you want to support a great organization like Lollypop. So how do you report it? Again, hopefully most of you use enrolled agents, CPAs, but even if you use that good old program, I think they call it TurboTax, the software has become almost idiot-proof these days. So if you have a very simple return, it will really walk you right through the process. But you report it. On the taxable amount, you put 0, and next to it, you put QCD. But once again, we encourage everyone to use a tax preparer or an enrolled agent or a CPA. Even if you do your own taxes every year, because it's simple, we encourage you every 3 to 5 years have a CPA review it. Pay to have it done every 3 to 5 years. That way, if you find out that you've missed a credit or you've made some mistakes, they can go back and amend those past returns. Okay, so again, not real expensive to make sure it's done properly. If the check is made payable to you, so if you say, I'm taking that 20 grand out of my IRA, I put it in my bank account, then I write a check to Lollypop Farm, that is not a qualified charitable distribution. It has to come directly from the custodian. And the maximum that you can do is $100,000 per year. How many of you have heard of donor-advised funds? 1, 2, okay, 3, good. They've become very popular over the last number of years. Because the standard deduction has gone so high, and most folks are no longer itemizing, people ask, how can I still support the charities I believe in and still get a tax deduction? At least every couple of years. Plus, some individuals have a liquefying event, so they sell a business. They come into a large lump sum of money that's taxable. And they're in a high tax bracket this year, but next year and the years following, they'll be in a lower tax bracket. We want to get that tax deduction today while you're in the higher brackets. So effectively, what you do is you give cash or other assets to a donor-advised fund. You get a tax deduction in that current year. So if you normally give $10,000 a year to Lollypop, you could give $100,000 into the donor-advised fund. Now, you've made that charitable contribution. That $100,000 is no longer yours. Okay, you've made that donation, but it's held in this account, and it's invested and it earns tax-free money. And then every year, you send the check to Lollypop for 10 grand. Year 1, year 2, year 3, year 4, year 5. Okay? So you get the big tax deduction in the year that you really need it because you're in a higher marginal tax bracket. And then you take your standard deductions, years 2 through 9, and then you revisit and possibly do it all over again.
And
So
that money's still invested,
still invested.
making money.
Making money
Hopefully.
and invested in a manner that is comfortable for you based on your time frame, your risk tolerance, et cetera. So you can be very aggressive with it or very conservative or somewhere in between.
But none of it is yours anymore.
None of it's yours because you're getting the deduction all up front. So I had a client who sold a business just last year, and he funded it at a pretty good level, but he saved, he was in Massachusetts, so he saved about 45 cents on the dollar between federal and state tax. So great way for him to fulfill his charitable contributions and meet those obligations, but really get a nice tax break in that 1 year that he really needed it. So immediate tax deduction in year 1, funds invested tax-free, support the charities you love over time, most advantageous in the year that you're, again, in a higher tax bracket and you are able to itemize, obviously. Easy to contribute, a lot of different assets, maximize tax benefits, very simple, and support legacy planning, all the things that obviously most of us want to do. So charitable gift annuities, and I know Kathy and Robin put some of their brochures out which outline some of these techniques and options as well. But charitable gift annuities, if you want to make a significant contribution to your charity that you care about, but you also want a fixed and reliable income for yourself for the remainder of your life, it works very well. So you give an asset away, and then you actually, in return, receive a stream of income. You have to be over age 55. You can provide that income stream for 1 or 2 people. So husband and wife, we can make sure that you're supported, that income continues in for both of you. At your death, whatever the remaining value of that annuity is, goes to Lollypop Farm and provides current income partially tax-free. Many times we see clients, again, this is where we can combine strategies. Client has a highly appreciated asset that's only paying a dividend of 1 or 2%. So all they're doing is peeling off the dividend every year. But 1 or 2% isn't a lot. But they can't afford to sell the stock because they're going to get killed with capital gains. So why not gift the stock to Lollypop Farm, let them in turn invest it into a charitable gift annuity. You get an income stream based on your age. It could pay you an income stream of 7, 8, 9%. You get a higher level of income to support your lifestyle, because we know Social Security always keeps pace with inflation. And if you have a traditional pension plan, most of them have no cost of living, or if they do, it does not keep pace. So it's a great way to give yourself that extra raise. So you turn a low-yielding asset into a higher income stream, get a current tax deduction. Whatever remains when you pass or your spouse passes goes right to Lollypop. Wonderful way to do it. And here's an illustration. You gift the asset, in turn you get income and a deduction, and the remainder goes to the Lollypop Farm. Charitable Remainder Trust, Charitable Lead Trust. Now I'm going to spend about 2 seconds on these. If you're looking to give sizable funds to Lollypop and you are in a higher tax bracket and higher net worth, it can work very well. So a Charitable Remainder Trust kind of looks like that gift annuity. You give cash or other property into an irrevocable trust that your attorney would draw up. You would receive an income stream for a certain number of years or your life, and then the named charity receives the remainder at your death. Okay? So again, you're getting the income stream. Whatever's left goes to the charity. But what if you're in a situation where you don't need the income, but you want the asset to go to your children or your grandchildren? So a charitable lead trust is Lollypop. You put the assets into a irrevocable trust. Lollypop Farm gets the income stream for a certain number of years, and at the end of the trust expires, and then the assets that are in the trust go to your family. Okay? So whether you need income or you don't need income, there are options available. But again, you want to speak, obviously everyone's situation is going to be a little bit different and unique.
We have a question from the Zoom
Yes.
chat. The question is, can I put IRA money into a charitable gift annuity?
I believe the answer is no.
So the only way I think you would be able to do that is you would be, not directly.
Okay.
I don't believe so. Yeah. But I encourage you to talk to your tax person. So that's kind of the conclusion. So does anybody have any questions or anything that we didn't touch on that you thought we might?
Basically, every situation is different based on somebody's income, but is there any one choice you think for the certain income range for people that you may deal with on average? They think that with 40,000 to 80,000 per
Right.
se, let's say if that may be your generalized income association, that people may choose donor or trust or as such, because they definitely would need an income on a regular basis,
Right.
and then have, like you say, the rest go after their passing.
So again, I think that's really why I started with the tax brackets. Because if you look at let's say if you have IRAs and Social Security and pension and a small pension, and some investments, but even if you're generating $100,000 a year of income, that's a pretty comfortable retirement for a lot of people. So between your Social Security and your required minimum distributions, you have $100,000 of income. And you're married. You get a $25,000 standard deduction, even if you're not itemizing. That brings you down to $75,000. What's your marginal tax bracket if you're married filing jointly? 12%. If you're single and you have half that income, again, you're just 12 to, you're still very low tax bracket. For many of our clients who are over age 70 and a half, the qualified charitable distributions just are so simple, so easy. They work. It's just a win-win.
We receive a lot of gifts that way.
Yeah.
Ever since that tax law changed, that's the way a lot of people are going.
Yeah.
Is there something similar to that for 401ks?
What you could do, though, if you want to maintain your assets in a 401k, you can do an IRA rollover. So if you are planning on doing qualified charitable distributions, let's say you're doing 10 grand, just to pick a number. There's nothing to keep you from rolling $10,000 out of your 401k into an IRA. Just roll it into an IRA money market account. Once it's there, do your QCD. Yeah, so you just got to play the game. Yep. But good question.
I have a question about this slide. This is long-term capital gain.
Yes, sir.
Married filers. Am I reading this correctly? If we have capital gains in a given year for $80,000, we pay no taxes on it.
No, that's your adjusted gross income.
Ah,
So, okay, so again, if your Social Security, earned income, and all that.
got it, okay.
So once again, let's go to the example of individual with 100,000 in income. They take the 75,000 or the 25,000 standard deduction. They're at 75. If they were to sell an appreciated asset and only incur a $5,000 capital gain, they're going to be in the 0% bracket. So again, there's no tax savings to give Lollypop the stock to sell versus you selling it. But it's a lot more convenient and easier for them to do it.
Got it.
It's
Thank
automatic.
you. Sorry for the stupid question.
Oh, no, not at all. Not at all.
I'd like to just skip forward and put your contact and my contact information on
Sorry,
the
I went all the way
screen.
back
I
to
know,
the
you went all the way
beginning.
backwards.
Sorry,
We were
Kathy.
right there.
I also have a comment on Zoom. Nice job, Kevin. Very well done.
Thank you.
Indeed.
So if you have any follow-up questions that we didn't have a chance to go over tonight, just feel free to reach out to either one of us. We're happy to answer them and help you in any way that we can.
All right. Again,
Thank you.
Thank you so much. Really appreciate you coming out tonight.